Hello and welcome. And you're watching ET Now. I am Harsh Saita and wishing you and yours a very happy Samvat 2082 to start this conversation with. But I have a very, very interesting personality within the Indian investing world that I'm going to speak to today, and it's going to be a very engaging conversation. Let me start off by introducing him. Really needs no introduction, but a sort of Warren Buffett of India, if I can call it, consistent compounder and very, very notable investor over the last 3 decades. Let me bring on board, absolute pleasure of mine to bring on board Prashant Jain from 3P Investment Managers. Welcome, sir, and wishing you, yours and your entire team a very, very happy Diwali and happy Samvat 2082.
Harsh, thank you so much for having me over on this show.
Right. So pleasure is entirely mine. Let me be unequivocal about that. Sir, let me set the context. The last year or so has been a year of patience, if I can call it, for the Indian investor. You, of course, with all the truckload of experience you have, you would have seen plenty of years like this. But the reasons for that, I would believe, to some extent, are twofold. One is there has been consistent FII selling, and second is that we've not seen EPS growth kick through. Let me talk about the second one first. We've seen plenty of measures taken by the government, and this is one of the crucial questions that most people are asking today. Does EPS growth for corporate India look brighter over the next 6 months, or would you say that maybe it will take 12 months for EPS growth to kick through?
Warren Buffett has said that equities are a device that transfer wealth from the impatient to the patient. So the only thing you need in equities apart from decent understanding is loads and loads of patience. And when I started my career, the first 10 years index delivered zero returns. Between 1992 till 2003, the index returns were zero. But the subsequent 5 years, the returns were so high that they made up for the entire holding period. So equities are a very simple asset class. They may give you excess returns ahead of earnings growth. In some periods, they may give you returns below earnings growth for some periods. But in the end, both tend to converge. So I think the nil returns of last 1 year, the reasons were pretty simple, and I think it was discussed 1 year back also. Post-COVID, there's a lot of, from a very low base, the returns were extremely high. And a lot of excitement was created, a lot of positivity was there, a lot of new investors joined. And in that momentum, because of this large flow of money, the markets probably overshot the fair value levels. And that is what is the primary reason to my mind of this 1 year of time correction. I think there was one more issue here, and that was around earnings. The corporate profitability in India was extremely low. Large banks were under stress. Capex was weak, commodity prices were low. From that very low base, the growth in earnings was much higher than nominal GDP growth rates as margins normalized. And I think to some extent, there was an extrapolation of the trend, and the expectation 1 year back was that the earnings growth will be around 15%. I think those earnings expectations were aggressive because margins cannot keep on expanding indefinitely. And therefore, with the real earnings growth of last 2 years, last year and the current year, half year, I think earnings expectations have also been reset. I think that probably led to some disappointment, especially with the foreigners, because they are willing to pay a much higher valuations of India versus EMs, provided you have those earnings growth to back up. But as earnings growth slowed down, I think they felt that those Indian markets should trade lower or they had better opportunities in other markets. And that's why we have seen persistent selling by or on and off selling by foreigners. Now, where are we today? I think with this 1 year of time correction, India has underperformed EMs by 20 odd percent. We have underperformed China by even a higher margin. And today, the premium of India over other EMs has come down to average or near average levels. The earnings growth expectations are also far more realistic today. So I think over time, these markets should do well. What we have also observed in the past in that markets, when they consolidate around one level for 1 year, 18 months, etc., typically the next move is on the way up, not on the way down, because earnings have grown in that period. And market in this last 1 year has withstood and held its ground on FI selling on more than one occasion. So I feel the markets over time should move higher. However, you mentioned one point of 15% earnings growth. I think India's real growth will be maintained. It may actually move a bit higher also. We should continue to grow between 6 and 7% in real terms. But clearly, inflation in India is a lot lower today than what it used to be in the past. And therefore, the growth of economy in nominal GDP terms and therefore the growth of top line of companies is around 10-11% in aggregate terms. So I would not expect Nifty to compound around 15% over the next 3, 5, 10 years. My guess would be it should compound somewhere closer to 11-12%. Yes.
Understood. So I will come to that. You spoke about how margins have surprised on the downside, which has led to EPS not keeping up with estimates. I want to take a cue from that and try and understand as to where you see it today. Do you expect margins to sustain at current levels, or do you still see some bit of possibility of margin erosion happening? Give us that sense, sir.
So Harsh, I think margins have fully recovered in last 5 years. Margins hit a very low level around COVID for a variety of reasons. And since then, the recovery has been extremely strong. I would by and large expect the current margin levels to remain flat or very, very range bound over the next few years. But that means your profit growth will slow down, because if margins remain flat, then profits will grow essentially in line with the growth of the top line and aggregate terms, which is around 11-12%.
And sir, you've been talking a little bit about behavior here. You've had long periods of time where you've had to be very composed with regard to the bets you've made. And right off the bat, I can think of two bets that you've had to play over the last 10 years maybe. One was the PSU theme, which you played beautifully. You took all of the pain and yet you continue to play it. And the second theme is, which off late you started being bullish on, is the private sector banks. So just from a behavior perspective, what is it that keeps you composed despite a possible underperformance that is playing out? You just focus in on earnings and say, as long as earnings is doing fine, we're okay. Is that how you think? Give us that sense.
I think, Harsh, this is key to equities. I think the key to equity is good investing, to my mind, first is to have a good understanding of what you are buying. And so many of us, we simply focus more on momentum as a decision criteria than the understanding of the underlying business. What are the likely growth rates and what are we paying for it? So I think I have always invested based on, I would believe, a reasonable understanding of the underlying businesses, had a reasonable sense of what likely growth could be, and have refrained from overpaying for that growth. And I have seen time and again, not just last cycle, but even over previous multiple cycles, that if your understanding is right, if business continues to grow, and if you have not overpaid, it is only a matter of time before the price reflects the underlying fundamentals. On the other hand, if you invest based on momentum and you overpay or you overestimate growth rates, the long-term returns will be very disappointing. And that again has been experienced multiple times. So I mean, this is the way I invest. This is what I am capable of, and I play to my strengths. And I don't see any other reason how a person like me can add value. So, except being patient. And when I bought into the PSUs, I think we were careful by and large to buy the stronger companies. They were, in some cases, there was pressure on profitability, but that was temporary. The underlying intrinsic value of the businesses were growing. And when do you buy great businesses cheap? When the near term is in pain. So confidence to hold them for the long periods comes essentially from the understanding of the business. What are the drivers of profitability? What are the drivers of growth? And if they're intact, then you are able to handle the pain of price underperformance for some time. We must distinguish between size and speed. So India indeed is a very large TAM. India is the world's fourth largest economy, soon to become the third largest economy. It's a 4 trillion economy going to 5 trillion in few years. So it's a very large economy. It is also a fast growing economy. It is of the top 10 economies, it is probably growing the fastest. And what makes it the fastest growing economy is a 6 to 7% real growth of the economy. Now, what is top line? It is real growth, volume growth plus inflation. So we are celebrating low inflation. Government, RBI, everyone has done a lot of work over the last few decades to bring inflation down sustainably. And it is a extremely good development. But that also means that if you measure your growth in local currency terms, your growth rates will be commensurately lower than when inflation was 9%. So today 6-7% real growth, 4% odd inflation, that takes you to about 11 odd percent. As I discussed earlier, margins to my mind in most of the large sectors have very limited room to move up. How have you brought inflation down? You have brought inflation down by opening up, by reforming the supply side, by freeing up imports, by improving your logistics, your infrastructure. E-commerce is leading to better price discovery. So competitive forces are increasing in virtually every industry, which is great for competitiveness of businesses, which is great for consumers. But the flip side of that is it will lead to lower growth in rupee terms. So I think 11-12% is the way to go. At the same time, India's hopefully the depreciation of rupee in dollar terms against the dollar should be much lower, because the gap between Indian and US inflation is sharply down. So if you look at last 30 years, India has been the best performing market along with US in the world, but the dollar returns were around 9-10%. So 15% was your local currency return, and your rupee was depreciating maybe about 6% a year on an average. So your dollar returns were 9-10%. I think next 10 years it should be the same. So your nominal growth may be 12. If rupee depreciates 2-3%, you again come back to that 9-10% dollar growth. So I think it is optical. If you measure the wealth creation or the increase in purchasing power, there is no difference between the past and the future. But yes, in rupee terms, the wealth creation will be lower. You can also get a sense of this from when I bought my home. We were paying 12% on home loans. Today, you can get a home loan at 7.5 to 8%. So why have interest rates come down? Because inflation is down. So I think it is suggestive, low interest rates, low inflation, low rupee depreciation, low CAD. They are suggestive of very strong economic fundamentals. I think we just need to differentiate between real wealth creation or increasing purchasing power and rupee growth. So I don't think wealth creation will be adverse compared to the past.
Okay, so that's wonderful perspective. Thank you, sir. I want to also try and weigh in on some sectors which you have in the past somewhere suggested have been slightly overvalued of sorts, or there's been lesser margin of comfort. Let me tone down the language. There's been lesser margin of comfort on some of those sectors, and to a certain extent that's FMCG, but also there is some bit of pessimism with regard to growth in some of these segments, because there seems to be a growing concern that while the addressable market is large, there's a huge penetration of these products already existing in the current economy. Talk about IT, they've grown very, very large. Talk about FMCG, they've grown very, very large. Do you believe that some of these sectors will be sectors of the past, or do you expect them to continue to possibly play the rotational trade and come back into vogue in the next couple of years?
No, Harsh, I think it is a very fair comment that growth rates are a function of not just the addressable market, but of the penetration levels. And many consumer categories, especially in the staple space, are highly penetrated. And just because incomes grow, it does not mean you will use more staples. So the consumer discretionary products are likely to grow faster than the consumer staple products. And ditto for IT companies, they have gained share massively over last 30, 40 years. And I think their growth rates are now by and large converging with the market growth of IT services. I think the expectation is that these two sectors should grow anywhere between 5, 6 to 7, 8%. Now, there are two more things here we need to take note of. One, both these sectors don't need capital to grow. So the payout ratios in many of these companies in these two sectors are extremely healthy. So you need to add back the dividends when you assess these investments. And I wanted to mention one more thing. Yes, it is the multiple. See, there is a price to be paid for different levels of growth. If a business is growing faster, you will pay a higher P, and vice versa. So often you will find that growth gets mispriced, and even slower growing sectors can become much cheaper than the fair levels. And even when that happens, if you participate in them, apart from earnings growth, apart from dividend yields, you can once in a while hope to make some money on multiples going up, multiples re-rating also. And that applies in reverse to overvalued sectors as well. So currently I feel, the multiples on the consumer staple space could have some more room for downside. I think in IT services, I personally feel that by and large, the valuations are at reasonable levels.
Fabulous, sir. So how are you playing the consumption theme then? There's just, everyone's talking consumption at this point. How do you play that?
So I don't think, there can be a very appropriate answer to that probably without going into individual stocks. So I think we are preferring consumer discretionary businesses more than the consumer staples businesses. But by and large, I must say that the consumer consumption theme in India is pretty expensive. See, whenever you enter a phase of narrative-based investing, that narrative, it tends to become expensive. It happened to the defense companies, it happened to capital goods companies. 5 years back, it happened to chemical companies. And I think consumer also has been a dominant theme, a narrative-driven story, and that's why we are seeing some underperformance in that space.
So there was plenty of chatter maybe 12 odd months ago with regard to the small and mid cap space in general being overvalued. I know, sir, you're a bottom up investor at your very core, but talk to us about how valuations are currently looking. We've seen a flatlining in terms of the index. In fact, so mid and the small cap has actually corrected. Talk to us about how much of that correction is done, because when I think of valuations, you're one of the first people I can think of in terms of understanding prudence in the market. So give us your sense.
So Harsh, I think I have said it repeatedly that small mid caps are very expensive, and I would clearly prefer large caps in this at this point of time. So in small mid caps, it is a wrong notion. As a category, I don't think they outperform large caps over long periods. But yes, post-COVID, the small mid caps have delivered high returns. And the simple reason for that is that in the COVID fall, if large caps fell 30%, small mid caps fell 40, 50, 60%. And because of the much lower base, the returns have been much higher. But I don't think that can be sustained. And bulk of the new stock supply is also in the small mid cap space. It is not in the large cap space. So I think over time, large caps, to my mind, should outperform small and mid caps.
So, you know, one theme which is playing out is that there is very little margin of safety in certain sectors. But at the same time, there's very strong growth as well. How should one look at it? Is PEG ratio the right way to look at it? Let me give you an example. So healthcare, right? You've got some of the stocks trading at 50, 60, 70 times earnings, but the growth, the underlying growth is closer to 20% on average. Would that be something that would attract your attention? And if so, what's the kind of PEG ratio you would look at if that were to be the metric that you track?
I don't think you can look at a PEG ratio as a thumb rule, and I don't think a generic answer is possible for that, because different businesses are different, and some businesses have high free cash flow generating ability, some have low, some have cyclical in nature, some are less cyclical. So I don't think I would like to give you a specific number, because it could be quite misleading.
So thank you so much. You've been very, very gracious with your time, and it's been an absolute pleasure. Wonderful, wonderful talking to you. Thank you so much, sir.
No, thank you, Harsh. Thank you. Bye-bye.
Bye. And with that, viewers, thanks so much for tuning in.